Good morning, everybody. Let's get going. So I think it's 11 o'clock now. So this week's guest is Tony from VH Global Sustainable Energy Opportunities. So we'll get to him in a minute, but first I'm going to run through a bit of news for the week. So three things really that I picked out. One is Oakley Capital results, which are pretty impressive. And then I just wanted to contrast the Alliance Trust results with F&Cs, just kind of to top of my level. And then talk a little bit about Henderson Opportunities. Oakley first. I mean, the graph kind of says it all, really. It's been performing extremely well. But despite that, the discounts opened up a bit over the past year and a bit, which is common to a lot of other private equity opportunity companies. And I think that's probably wrong. There it is in the context of the sector as a whole. Although I've chopped off the tiny one, the sort of foreign ones off the bottom. The only thing I suppose that people might balk a little bit about is the ongoing charges ratio, which is relatively high. And that reflects the fund structure, the fee structure on the underlying funds, not really at the top co level. It's not the only fund like that, obviously. We are looking into the whole area of ongoing charges with Morningstar because we found a few instances where they weren't quite consistent. So we need to get that sorted out. But the whole fund of funds thing is something that is generally as an industry we're trying to sort out. Here's the performance record though, and this is really, I suppose, why we're talking about this. It is now the leader in the sector over 5 years and 3 years in terms of NAV, and even in terms of share price over 5 years as well. Longer term than that, as a 10-year numbers aren't quite so good, but it did sort of have as a revamp investment process over that period. So you'd expect the 5-year numbers to be better, hopefully. And it would have been number one over 1 year as well, except for the incredible performance of Literacy Capital, which, as we know, is sort of knocked it out of the park since it listed. The thing that I pulled out here as well is that just how much better these private equity funds have been doing in terms of NAV returns than the global equity funds, the normal listed equity funds. It really is quite significant now. You look sort of like 4% a year over 10 years. That adds up to quite a big number. That's not true in share price terms. And I kind of think that investors may be thinking, well, listed equities are really bad, so therefore private equity must be really bad, so private equity must be overvalued. And I can't get my head really beyond that. I can't think of a reason why these discounts got so wide. But there we go. These set of results, as I say, it was a very good year in a year when most markets were down. They actually measured themselves against the all-share index, and that was minus 3% over the year. But against the sort of wider global index, which is down 8.1%, it's a massive outperformance. In share price terms, as I said, the share price didn't really keep up. LPX Europe is an index of listed private equity, so that represents share price moves as well. So it did hold up relative to other listed private equity companies, which saw a big widening of their discounts over the period. Nevertheless, that's to say nothing to shout about. I think the most important thing for them is that the returns have been largely driven by the growth of the businesses that they hold. So that obviously feeds through into underlying valuations. And so underlying EBITDA growth of 22% last year is really quite a big number. And that has driven a lot of this NAV. The other thing, though, that's helped has been that the things that they've sold at quite a big premium to carrying value. So average of 70%, that is higher than normal. They say normally sort of 50% over the long run. And they're making almost 5 times their money on these things. And as my colleague Matthew was saying, he went to the results meeting. So they're saying they are turning things over relatively quickly. So from making investment to actually realizing it, sort of sub 5 years. So this again, that's still quite impressive stuff. The three big disposals or write-ups that made the difference. There's a German education thing called IU Group, and then the two like software companies. In some cases, Oakley still has an exposure to these things, and I know that there's been a bit of press comment about the extent to which private equity sell to each other, and that maintains the values higher. Oakley will only write something up if there's been a sort of disinterested third party making investment at the same time. So somebody has sort of had a critical look at it. So those figures are kind of real. In terms of their capital position, so that they roughly matched investments and proceeds from disposals last year. They've got outstanding commitments of about 900 million now, because they're in a big commitment to the Oakley's new Fund 5. But that won't all be called down in one go. And probably they're saying over 5 years, and not all of it will be called. So it's, again, there's no real overcommitment problem to worry about here. They've got resources of about 210 million now. And they're talking candidly about selling to their remaining direct investments. And most of it's now through fund investments in the Oakley funds. But they've still got these things, North Sales, which is actually just mixed sales for boats, but also apparel as well, and Time Out, which you remember is the listings magazine, but is actually really more now about these sort of giant posh food courts in various cities around the world. And both those businesses have had a big recovery post-COVID, seem to be trading quite well. So we could actually see exits from those in 2023. And then the final thing to remember is, with all of this, Oakley's in control of both sides of the equation here, so it can control when the money gets called down. So there's no problem here that Oakley Capital Investments is going to run out of money. In terms of the valuations, yes, valuations are higher than listed equity averages, but that's because of the mix of sectors that it's got in the portfolio, the mix of the success of those companies, really. And as it says down here, these are the sorts of companies that it feels will hold up quite well in any kind of downturn, because they're profitable and cash generative. It's not sort of doing to the venture tech or anything like that. And they're asset light, so they're not really affected by inflation so much in terms of their input costs. So they think they're going to be seeing another successful year going in here. And they do get an uplift from going in at an average of 13.6 last year, coming out at an average of 15.9 last year. That's part of what they're trying to do, is to reposition these businesses when they buy them to make them more sellable. They're not doing that with an awful lot of debt. I know that is higher than the MSCI World average, but that's still not excessive. And that has been fairly consistent in recent years. This is not driven by that. And then finally, on this point, this is sort of a summary of where the managers think the private equity is as we go into 23 and this sort of more difficult market environment. They are saying that they're seeing a slowdown in fundraising, notwithstanding the fact that their Fund 5 kind of broke records, and they were very pleased with that. But nevertheless, as they see further down there, there's about $2 trillion of uninvested money in the private equity sector ready to invest. So that will keep the party going for a long time, really. And most of the time when we look at these things and historic downturns, the private equity NEVs actually hold up quite well. I know the share prices don't, but the NEVs do. So my gut feel is that these things will have a relatively good year, maybe not another amazing knockout year that they had last year, but nevertheless, it would be relatively good. These things are too cheap, but there we go. I'll keep saying that. Now, Alliance Trust versus F&C. Obviously, they're the two big generalists in here, apart from Scottish Mortgage, which we know is quite a different beast. And if you look at their returns, actually, Alliance Trust is now ahead of F&C over 1 and 3 years, just behind over 5, and still behind over 10. So it does seem to be picking up, and that's what they've been trying to do with this move to Willis Towers Watson, to try and beef up the whole investment process and improve the outcomes for investors. Both of them announced results this week. They both saw another uptick in their dividend, and the track records of these things are really getting ridiculous now. So 56 and 52 years that they've been consecutive dividend rises. But on the headline numbers, Alliance Trust was underperforming F&C. I mean, although both outperformed the All Countries World Index, nevertheless, this is that one was lagging the other. But if you look actually the returns on the portfolio, the equity portfolio, then Alliance Trust was actually doing better than F&C. So the stock picking is a bit better there. So what is the main difference, as you've been asking? And the main difference is the change in the fair value of debt. Now, this is not something that we labour very much anymore. We've been back and forth on this. It was a real problem if you go back a couple of decades. But really, as interest rates have been falling for a long time, for the most part, the problem that the funds have had is that they took out expensive debt for long term, and that looked more and more expensive as interest rates fall. Now we seem to be having the other situation where the debt that they've got, and this is from Alliance Trust's balance sheet. So in terms of the sort of long-term stuff that they've got some debt matures in 2030, 29, 23, 43, 53. These are now relatively low rates. And so as gilt yields move, that becomes more and more attractive. And this chart tries to explain what's going on here. So basically, the horizontal lines are the Alliance Trust's fixed cost of debt on those different debt issues. And the other lines, these sort of wavy lines, they are the yields on the equivalent government bonds. So the 10-year is 33, 20-year 43, 30-year 53. So they kind of match up. So for a long term, the cost of borrowing was well above the yield on the gilt. Now it's well below. And so therefore, what the lenders that have lent to Alliance Trust would love to do is for them to repay that debt so that they can lend it out now at higher rates. And that means they've got a sort of a fair value positive impact on terms of their NAV, because obviously all of the NAVs that we report are come fair, including income and fair value of debt. So just to explain that, I think that's important that people know what's going on with that. And to answer the questions that are popping up here now, so no, Alliance Trust has not done anything wrong. It hasn't messed up its debt. It is just a factor of the fact, that they've actually borrowed cheaply, and if anything, they've done something right here. But F&C borrowed more of it. We'll come back to the other question later on, I think. So last thing, Henderson Opportunities. This is the result of its AGM. So you can see there all the resolutions and all the votes that were cast for and against. And come down here to number 11, the continuation as investment trust, and it becomes 1.5 million versus 570,000. That's quite a big vote against in the scheme of things. And it's the sort of thing that boards have to wake up and respond to, investigate why it happened and respond to shareholders. But the really annoying thing with all of this is that actually, despite the fact we've got a continuation vote on the fund, so it determines whether it's going to continue going or not, only 26.5% of shares were voted. So the actual number of shares that 500,000 there represents is just 6.4% of the issue share capital. And had shareholders of 20% of the register voted against continuation, then that would have been it. They would have lost continuation vote, and the board would have to be running around trying to find solutions to what to do next. I think it just underscores really the danger of not voting. And I know because I was at the ARC Directors Conference yesterday. Hargreaves and others have actively been trying to make it easier for you to exercise your voting rights. And so I do urge you to do that if you can, especially on things like continuation votes, where it is important that your views are taken into account. Now, there's a couple more questions here that I should tackle before we talk to Tony. So first of those, saying under the FCA's Consumer Duty Directive, platforms are soft closing investment trusts that host special private equity, so investors are unable to make new or further investments. Fidelity have been really strange in this because they did it to Aberdeen Private Equity and they wouldn't tell us and they wouldn't tell Aberdeen Private Equity why they did it. So we've got absolutely no idea what it would take to fix that. And that I've just found incredibly frustrating. It might be something around the ongoing charges ratio, but it just doesn't make any logical sense to me. So I think the crisis is people should be rating it Fidelity and asking what they're doing because they don't have to do that. And the other question asked by the same guy is about long-term asset funds, because Schroders are talking about launching a long-term asset fund. And I still think these are really fundamentally flawed because the whole point about a long-term asset fund, the idea is that you, as we know from Woodford, you should not be holding illiquid assets inside an open-ended fund. It's just a disaster waiting to happen. But despite that, the FCA has allowed the persistence of open-ended property companies to property funds to persist, and it doesn't make any logical sense to anybody that I know working in the investment companies industry, in the REIT industry. It's just nonsense. So, but the FCA won't, for whatever reason, take action, and instead they've come up with this convoluted idea called a long-term asset fund, where you can launch a fund and then people give notice if they want their money back, but the notice period is like sort of 3 months or something. I just cannot see why any investor would want to do that. Definitely not a retail investor. It just doesn't make any logical sense to me. So it's going to be really interesting to see how they do. I don't think they're going to work, to be honest. And then everything else that is between the investment company and the long-term asset fund is going to be more or less the same, except one will trade artificially at NAV and the other one trades at a discount. So there we go. And I think I'll leave it there if that's all right. So let's now move on.